After the aggressive 50 basis point rate cut earlier this month, the US Federal Reserve seems to have complicated its task. On the one hand, inflation risk persists, requiring a cautious approach to the rate adjustments, and on the other hand, the threat of the economic recession remains intact. This is why the US dollar has been swinging wildly between gains and losses. Early Thursday trading saw the dollar strengthening against major currencies in anticipation of the labor market report and other important data. Let us examine how the macroeconomic reports, slated for release on a Friday, September 27, may affect the dynamics of the main currency pairs. You are watching Traders Calendar. It's clear that inflation is the main indicator guiding central banks' policies, with a preferred annual growth of 2%. If this target is exceeded, we are dealing with a rise in inflation. If consumer prices fall short of 2%, the country is likely to face deflation, which could be followed by a recession. In the event of this, the country experienced a drop in economy prices and the labor market as well. Japan has served as a strong example of a battling deflation for years. Therefore, the consumer price index set to be released early Friday should reinforce the hawkish stance of Japan's central bank, potentially driving the yen higher. A decrease in inflation is also expected in the Eurozone economies. However, unlike the yen, the euro will likely weaken if French prices fall. The European Central Bank's policy is focused on lowering the key interest rate. Thus, if the inflation rate comes in at 1.6% or below, traders are likely to sell the euro, pushing the euro-dollar pair down. And this downward trend may continue shortly after, as Spain's inflation data will be issued. It's expected that the annual inflation rate will drop to 1.9% from 2.3%. Another blow to the euro may come from the Eurozone Economic Sentiment Index, although the forecast suggests only a slight drop of 0.1 points. Even such a small decline could amplify concerns about the continued economic downturn in the Eurozone, and this pessimism could discourage buyers of the euro. The second half of the Friday's trading promises to be tense for the markets. At the start of the US trading session, the Fed Reserve's preferred inflation data will be updated. Price growth in the US economy is expected to slow to 2.3% from 2.5%. Since the Fed's target inflation rate is 2%, the slowdown will be positive news for the Fed, supporting its dovish outlook. The US dollar is likely to weaken. At the same time, the US will disclose its reports on personal income and spending. These figures are crucial as they indicate consumer sentiment, which drives the economy. A decrease in personal spending to 0.3% from 0.5% would signal lower consumer demand, which would put pressure on the greenback. Interestingly, just 90 minutes after this series of reports, the trend of the US dollar may change. The fact is that the University of Michigan will issue its Consumer Sentiment Index. Primarily, estimates suggest that it will rise to 69.3 points from 67.9 points. The report has shown steady growth for several months, driven mainly by purchases of durable goods. An increase in this indicator would signal sustained consumer demand in the United States, providing support for the US dollar. Please note that the time of publication is set in a GMT +3. The next video review of Traders Calendar will be released on a Friday, September 27. See you!